In this video, I would like to talk about speculative investing, understanding speculative investing. Is it actually worth the risk? Speculative investing is a high risk, high reward uh, investing strategy where investors bet on the future price movements of an asset, often with the hope of earning substantial returns in a short period. This approach is characterized by its focus on assets or markets with significant potential for price swings, but it comes with the risk of losing the entire investment. Actually, speculation is very risky, but if you are experienced, if you know precisely what you are doing, you can still make gains with this strategy. I want to highlight key strategies or key characteristics of this particular strategy. Number one is high volatility. Speculative investments often involve assets with price volatility, meaning they can experience significant price fluctuations in a short time. The nature of the investment is that it swings, it fluctuates, it like gyrates a lot within a short period. Examples include cryptocurrencies, penny stocks, and certain commodities. Number two is short-term focus. Short-term focus. Unlike long-term investing, speculative investing often has a short-term focus. Investors aim to capitalize on rapid price changes rather than holding assets for an extended period. They want to capitalize on that short-term, price movement in the assets they are invested in. Number three is market sentiment. Market sentiment. Speculative frequency, you know, is actually based on decisions on market sentiments. In other words, speculators, they actually base their actions, their threats based on market sentiments. They equally employ news or rumors rather than on fundamental analysis. This makes the strategy more about timing the markets than understanding the underlying value of an asset. They don't really care much about the fundamentals of the companies they're invested in, but they are really like moved and are catalyzed by news events, by sentiments, and by short-term actions that tends to affect the share price of the company they want to key into. Number four is leverage. Many speculators use leverage, borrowing money to amplify their potential returns. While this can increase profit, it also has a significant risk attached to it. If you borrow money, if you invest, with leverage or on margin, if you perform well, it will magnify your performance. If you perform poorly, it will equally, aggravate your losses. It's like a two-edged sword, kind of. So I want to look at common types of speculative investments. Common types of speculative investments. We have number one, penny stocks. These are low-price, small-cap stocks that are highly volatile and can offer significant returns if they appreciate, but are also prone to dramatic losses. If they plummet, you would sustain, a considerable level of losses. Number two is options trading. Options allow investors to speculate on the future price of an asset without owning it outright. The high potential for gains come with a high risk of losing the initial investment. Options is a little bit complicated. Is a highly complicated kind of investment that is meant or is as a result for people who are experienced in it. It's not just for everybody. Number three is cryptocurrencies. These digital currencies like Bitcoin, like Ethereum, are highly speculative due to their volatility and uncertainty surrounding their future adoption and regulation. Investing in cryptocurrency is highly controversial. It's speculative because you can't value it. There's no basis for valuing cryptocurrency. There is no fundamentals you could use to determine, their true worth. That's why it is considered as speculative in nature. Number four is commodities. Investing in commodities like oil, like gold, or agricultural products can be speculative, especially when driven by geopolitical events or changes in supply and demand. When you talk about commodities, you have to be very, very skillful and experienced in this area because it's essentially a speculative kind of investment. We want to look at the risk and as well as the rewards of speculative investing. The risks here actually involve there's that high reward potential. That's the advantage. This high reward, there's a potential for high reward. Speculative investments can offer significant and of course substantial returns, in a short, time, especially if the investor correctly anticipated market movements. If you can correctly predict market movement in advance, you will stand to gain. Then there's a risk attached to it actually. There is a significant risk. The high potential for profit comes with a possibility of significant losses, including the total loss of the investment. You could be wiped out, out of the entire scheme. You could end up losing your money completely if you're not very careful with speculation. People like Jesse Livermore, he lost his money in investing, and eventually he committed suicide. So speculation is something that I wouldn't really encourage you go into it. But if you feel you have the risk appetite and you can survive the downside, good and fine. You can give it a trial. So you have emotional decision making. Speculative investing can lead to emotional decision makings with fear and greed often deriving driving buying and selling decisions. Essentially, speculators are driven by not by fundamentals, not by reason or logic. They are driven by greed, by fear, by FOMO, and with the desire to make quick money. That's why it can be somewhat risky. The reward is that it has a high potential for higher returns. The risk is that you could lose your money. It comes with significant risk. I want to highlight strategies that could be considered in this regards. Number one is risk management. Speculators, must have a solid risk management plan, including setting stop loss orders to limit potential losses. You are advised to place a stop loss. In other words, your investment will not go below that particular price. Once it gets to that price, the system is designed to sell out, to dispose, the securities involved, immediately. Number two is market research. While speculative investing often involves betting on market sentiments, understanding the factors that drive price movement is crucial. If you fully understand the factors that drives or influences or have an impact on price movements, then you are good to go with this particular strategy. Number three is diversification. Even in speculative investing, spreading investments across different assets can help mitigate some of the risk inherent in these kind of investing. And so, who is it for? Speculative investing is generally suited for experienced investors with a high tolerance for risk and a solid understanding of the market they are trading in. You must have that high tolerance for risk. Number two, they must fully, understand. You must fully understand the nature of the market you are speculating in. It is not recommended for conservative investors or those who cannot afford to lose their entire money. If at the time they don't want to lose their entire money, and and you cannot really bear risk, please and don't go into speculation. Just like I told us earlier, this individual lost his life because of the losses he sustained in his speculative investing adventure. So it can be very, very risky. But if you get it right, it can be quite profitable also.